Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. US markets remain closed today on account of Labor Day, but there's still a lot of action going on in the markets. Last week's theme was loosening of labor market. If you remember, Fed in its commentary has maintained tight labor market conditions as another rationale to keep rates higher, and we have observed this historically as well. But despite all these data points, dollar has ended stronger, especially against the DM currencies, while China, with all its stimulus, has failed to prop up the yuan in any significant way. JK, what are your thoughts on this phase of dollar strength? Talk to us about what you will be tracking in the coming week.
Good morning, Swaraj. This dollar strength might have surprised some people because the labor market showed a weakness, and that is what the Fed is looking for, as you said. But there are a couple of reasons. Slightly, dissecting the data, one could find that the non-farm payrolls could have been even higher, around 240,000. But for some strikes in some sector, which was being affecting the number actually, and also the lower average earnings also was due to the fact that August month had fewer weekends compared to July. That's more of a technical thing. Therefore, the average hourly earnings came down. This can get corrected. But more than all this, this data was followed by a very strong ISM report, and the ISM report came much higher than expected at 47.6% compared to what was expected at 47, and most of the components of the data were also good. Like the employment was strong, the prices paid were above 48, though the data was still in contraction territory. Market perceived the manufacturing sector to be on an improving side. Therefore, this led to some short covering in the dollar, which had been sold off immediately after the data. Then we had the big climb in the treasury yields, which reversed hugely after falling post jobs data. The post data rally was actually capped swiftly on a closer dissection of employment report, hawkish talk from one of the Fed members, Mester, and then the stronger than expected ISM data, with pressure being applied, on mostly. More importantly, by a lot of supply that is being, once again envisaged in the month of September. As per indications, there will be about 125 billion of investment-grade bond issues next month, with a lot of it scheduled for this week itself. So as a result, we saw 30-year yield rising by 9 basis points, 10-year by 8 basis points, and the 2-year, after going down by about 3 basis points, was higher by 1 BP at the end of the day. So in the process of this rise in the bond yields, we had the dollar also reversing. Then, of course, we also had the Eurozone data, which has been underwhelming for several weeks, and then a few ECB members have decidedly turned less hawkish in their statements about the policy. More and more people now believe that September will be a pause as far as ECB meeting is concerned. With all that, we had a technical break in the euro at 1.0810. That was the 200 DMA that was holding, and we had a close well below that on Friday, and it could give some momentum to the euro on the downside, and dollar index as well, which is once again pushing above 104. Therefore, we had this dollar rally, which actually surprised after the weaker jobs numbers. Dollar yen, of course, taking cues from the dollar yields, which are pushing higher once again, and market getting emboldened by the fact that Japan has not been even talking about the weekend. So there can be an eventual push towards 150 on the yen also, just to test the tolerance of the central bank towards weaker yen. And of course, it can get more tricky around 150 because of real possibility of intervention. As you said, Chinese efforts at stabilizing their currency have only been partially successful, because it did not make a new high in the last 1 week, but it still stays closer to the weaker side of its range, and market is not really responding so much to what the central bank or the government would desire. Then coming to the rupee itself, the divergence between the global cues and the domestic economic news continues to keep the rupee range bound. After the beat of GDP coming at 7.8% versus 7.7 expected and 6.1 previous quarter, S&P Global India Manufacturing PMI rose to 58.6 in August after hitting a 3-month high in July at 57.7. And this is the second best improvement in the several sectors after 3 years as per the release. New orders and input increased the quickest rates in nearly 3 years during August, and then even output rose for the 26th successive month to the greatest extent in just under 3 years. So all this not supporting the rupee so much because the DXY higher bond yields and the 7-month high in crude prices has kept the rupee on the defensive. Of course, with steady offers seen from PSU banks at higher levels, interest from sellers is also emerging, which is keeping things in balance. Although we have seen good outflows in recent days, and as I mentioned in my earlier update also, the rupee closing above 82 for the first time in the last 10 months, and also having the highest monthly closing in August ever is keeping the buyers more interested on shallower dips, and now it is up to the central bank whether they would like to see the rupee weaker in line with the other currencies or not. Also, we had a very big jump in the oil prices on Friday. This is on the perceived shortage, supply shortage, and also the demand actually increasing steadily all across. Even the Chinese demand is seen to be increasing, and globally the demand is definitely now pushing the prices higher, while the output cut from Saudi Arabia and Russia are continuing to affect the give the prices a very good support. So we are closer to 90 on the Brent, and that is not good for India. Although the impact on the currency would depend on how the central bank approaches, whether they would like to keep the currency stable to avoid inflationary impact of the imported prices. But definitely it would affect our external balances. All said and done, today will be a quieter day because of labor holiday in the US, and this week itself is not busy compared to last week because of light data calendar, except ISM services and also the S&P Global's PMI services of various countries and the Australian Central Bank rate decision tomorrow. Other than that, we do not have much significant, but we'll definitely see how the yields react to new issuances that is coming from the US government. Thank you.
Thank you, JK. And just to summarize quickly, the dollar strength remains despite the labor market weakness which we observed last week, and this might be due to the strong ISM manufacturing report which came in higher than expected, showing an improvement in economic conditions. We once again observe pressure on yields, or a possible pressure on yields due to the new issuances by the Treasury. On the other hand, adding to the dollar strength is the Eurozone data, which has been underwhelming, and along with the ECB members being comparatively less hawkish and tilting towards the dovish side, helping the dollar strengthen. On the rupee, we remain range bound. Domestic factors remain quite positive, while global factors like yuan, oil, and dollar index remain unfavorable for the rupee. That's it from us today. Thanks for listening, and tune in tomorrow as we bring you the latest updates from the financial markets. Thanks for listening.